Hi guys, I hope everybody is doing good and this video is to update you about the amendments that are meant for the upcoming May 2022 exams, and this video is applicable to both CA final and inter students. I just want you to know that there are two updates, so CA inter, also CA final. For both of you this is very relevant. The two major amendments that you should be focusing on is one, section 143 subsection 3 clause J. That is the last clause which talks about other matters which are specified, and it goes on to describe the rule 11 normally, which had 4 points of pending litigations, material foreseeable losses, and transfers or delay in transfers to IEPF, right? That was the point. And then we had a point on what happened during the demonetization period. So now that point is removed and it's been replaced a whole lot of our content. So I want you to kind of understand what that is. So I have extracted that particular class from my recordings, which I use for my Google Drive classes. So I've extracted that and I've attached to this particular video. After this introduction, you will be able to see the changes. Plus also I would want you to be on alert with respect to another very important change, which is company auditors report order 2020 is now applicable, and I will follow it up in another amendment video where we will discuss that. So for now, what we are going to go ahead and see will be the context of 143 subsection 3 clause J, which will describe rule 11. And I want all of you to watch the whole video through and understand what the amendment or the changes and make the most of it. So I personally will see you in the next video, and now you can listen to the extract of what 143 subsection 3 clause J is all about. And the last point that we have to look for is 143 subsection 3 clause J. These are, like you say, the words as prescribed are used. Now you know that the moment as prescribed is used, we have to go for looking into the rules, and rule 11 is given in detail. There have been certain amendments to this particular rule and additions, so let us concentrate and try and understand what exactly we are supposed to report under 143 subsection 3 clause J, which is about such other matters. Please underline such other matters as may be prescribed. When they say as prescribed, you got to go to the rules, and rule 11 right here with all the details are there. So rule 11 of the company's audit and auditors rules 2014 prescribes the other matters to be included in the auditor's report, and of course you can go with the details of what those matters are, and it is very clear. I mean, the first set of 3 points are something that straight and clean. If the company has any pending litigations which are in the nature of contingent liabilities, we have discussed about this in standard number 501. Pending litigations, whether the company has disclosed the impact of any pending litigations on its financial position in the financial statement. Now that has to happen in the notes to account, so I just hope they did that. Plus whether the company has made any provision as required under law for material foreseeable losses. Now the word material foreseeable losses, I think that's going by a simple concept of prudence, right? That you uh, figure out what are the material foreseeable losses and accordingly provide for that. On what? On the long term contracts. Which one? Including derivative contracts, right? So derivative contracts which include futures, options, and all that. So if there is any material foreseeable losses that you are going to incur, then it is better that you provide for those. Plus whether there has been any delay in transferring the amounts to the IEPF. Again, I hope all of you are aware that under section 123 to 127 you read the dividend provisions. Now you know what is unpaid dividend, and if unpaid dividend is there, we have to keep it in a separate bank account called the unpaid dividend account, and if it remains in the unpaid dividend account for 7 years, then you might want to transfer it to the IEPF, and whether the company has any delays in doing so. So these are the 3 points: pending litigation, material foreseeable losses, and delay in transferring amounts to the IEPF. And then moving on to rule 11, sub rule number 4, where there have been certain points that are introduced, and it's interesting for you to learn this: whether the management has represented that, to the best of its knowledge and belief, other than as disclosed in the notes to accounts. See there, I've already highlighted and given that other than as disclosed in the notes to accounts, no funds have been advanced or loaned or invested. No funds. So this first of all involves funds, and I think you already very well know from 143 subsection 1, they've already asked the question whether any money has been given as a loan or an advance. So obviously we are bothered about shareholders money, and that is why points like these are being put up. The point is whether other than those disclosed in notes to account, no funds have been advanced or loaned or invested either from borrowed funds or the share premium, that is securities premium, or any other sources or kind of funds by the company to or in any other persons or entities, including foreign entities which are in the nature of intermediaries, with the understanding whether recorded in writing or otherwise, that could be in writing or an oral, you put up money, that intermediary shall, whether directly or indirectly, lend or invest in other persons or entities identified in any manner whatsoever by or on behalf of the company. That is simple, guys. You put money into a entity which is now called the intermediary, but did that intermediary use that money? No, they have further put it to somebody, and that somebody is called ultimate beneficiaries, or provide any guarantee, security or the like on behalf of the ultimate beneficiaries. I will read it once again for your clarity. I hope you got it, but we'll break it and read it in two parts. Whether, so if you have already disclosed in notes to accounts, that's okay because it's already disclosed. You don't have to do it again. Maybe if you believe it's very fundamental for users' understanding, as part of audit report, you can give a paragraph when you discuss audit report chapter, which paragraph under what that will come, we can see. So now, other than those disclosed in notes to accounts, no funds. So basically it is the money belonging to the shareholders, so they should know what happened with their money. Same logic, right? Because the ultimate owners of that funds are the shareholders. So either from borrowed funds or securities premium or into any foreign entities, including any of the including foreign entities, with the understanding that I will invest money into you and you will further push it on to them, like that, either in writing or otherwise, that intermediary shall, whether directly or indirectly, lend or invest in other person. So ultimate beneficiary, did you give money to somebody with an undertaking that they will invest in somebody else who is the ultimate beneficiary? If that kind of a transaction has already been disclosed in the notes, fair enough. But if something like that has not happened, now this is like misusing or channelizing the funds of the company to somebody else, and I don't want that money to go to the ultimate beneficiary directly from me. So that is why I'm routing it through an intermediary. Okay, so that is the first point. Two, whether the management has represented that, to the best of its knowledge and belief, other than again those disclosed in notes to accounts, no funds have been received by the company or any person or entities, including foreign entities, with the understanding whether recorded in writing or otherwise. This time the word used is funding parties, that the company shall, whether directly or indirectly, lend or invest to, again the same logic, ultimate beneficiaries. You used your money to send it to an intermediary, and from there they lent it to a ultimate beneficiary. This is the first point. You had an understanding with an intermediary saying that, look, I will give money to you, and then from there you will invest that money to the ultimate beneficiary. Second point is the opposite of that. Intermediary, as you received funds from the intermediary, and which in turn came to you from the ultimate beneficiary. So either ways, ma. So we don't want some transaction to be disclosed in clear terms, which is why they are doing like this and using an intermediary. So both of these are in likes of a shady transaction, which is why the point has been specifically introduced to highlight and identify such shady transactions, and audit has to play its part on bringing out these kind of transactions under 143 subsection 3 clause J, and where clause J talks about rule 11 sub rule 4. Okay, and then based on such audit procedures that the auditor has considered reasonable in the appropriate circumstances, nothing has come to the notice that could have caused them to believe the representations under clause 1 and clause 2 contain any material misstatement. So if you have any doubt that monies were either channelized or received, okay, so this is about ultimate beneficiaries getting benefited through intermediaries, or you received it from foreign entities or foreign parties with an understanding that you will push it on to ultimate beneficiary. Either ways, your money being channelized elsewhere, somebody's money being channelized through you, both are not workable. Understood? I mean, does these kind of transaction take place in real? Of course, shell companies are meant for that purpose only, and some companies do all these shady kind of transactions, and which is exactly why 2 points have been introduced. If you go back to the act in the beginning, these kind of points are not there. Well, there are a lot of things that got unearthed after demonetization that took place in 2016. So then there was one clause under 143 subsection 3, same clause J. The fourth point was whether monies that were held in specified bank notes. So that point was there earlier. Then with an amendment, that point got replaced by all this. And if you as an auditor believe that there is a possibility anything under subclause 1 and subclause 2 can be there which contained a material misstatement, then you should report such things also. But if your client is a genuine one, they have not received money from anywhere, they have not given money to anybody, must see, you cannot tell you can't invest, correct? Because it's a business. I would like to give some money to the subsidiary, I'd give money to somebody who's in the nature of a other company, or I would like to give a loan provided where I know that I will somewhat get benefited, either as a monetary benefit or for some reason. So these kind of deals happening practically, that's not a problem. But right now what you read is a absolute shady transaction, that using an intermediary to receive funds from somebody and then channelize, you channelizing your money to somebody. Well, these have been quite in practice and in vogue. So in the money laundering part, right, we would have already kind of you if you get a chance to understand how these things work in detail. um, of course there are so many movies that like depict all this, but not in that detail. You will see only some shady transactions being shown, money moved to this offshore bank accounts in Mauritius, Cayman Islands and all that, and then somebody suddenly eventually with 4 or 5 transactions they move the money. Okay, that is a cinematic experience just to trying to kind of push you through to say that somebody did this, but eventually it is somewhat it's not in plain sight. So that is why these points have been introduced. So one last time to close it, the reason why I'm emphasizing so much is when there are amendments and when there are these kind of points being introduced, they'd always want to kind of test you, and your papers have MCQs. So it's always better that you are aware of these kind of points. So point number 1, whether the company other than those disclosed in notes as related parties or whatsoever, whether they have loaned it to intermediary and they further sent it to ultimate beneficiary, or did the company receive money from some foreign entity and they channelize money to somebody else. If you believe that there are any shady transactions in clause 1 and 2, then you're supposed to report under rule 11 sub rule 4 and sub clause 3. Point number 5 is a straight simple point. Let's move on to point number 5, whether dividend declared or paid during the year by the company is in accordance with section 123. I don't think I have to explain you dividend provisions, you already know 123. And plus the last point is a very interesting point, again we've seen in audit in computerized environment. So whether the company in respect of financial years commencing on or after 1st April 2022 have used such accounting software for maintaining its books of accounts. So 1/4/2022 and later, for its books of account, which has a feature of recording the entire audit trail. I hope you guys know what audit trail are. It is a chronological record of all the transactions from start to end or beginning to end. So if you don't know, you can call it a log, and you can see the explanation below. Audit trail means a step by step. Guys, when you see that a security guard is sitting in the entry of an apartment or a gated community, they maintain a register, right? Whoever comes in, make a list. 10 1, somebody came, 10 2, somebody came, 10 5, somebody came. A trial is nothing but a log, a sequential or a chronological record of all the transactions. For now, I think in this part, that's much. If you remember, it's more than enough. Audit trail means a step by step sequential record which provides evidence of documented history of financial transactions to its source. Start to end, what happened, full detail. An auditor can trace every step of the financial data of a particular transaction right from the general ledger to its source document with the help of the audit trail. You know why this is introduced again? Lot of people, after the transaction is posted, then they want to make any alteration, something like that, they will go back and delete. So in many softwares, the fact that transaction got posted and got deleted later is getting recorded. So some people went on to an extent where they are manipulating the trial itself. Sir, what are you talking? How can they do that? With the help of IT guys. I think in the internal control chapter, we already saw that our team can collude with the IT team. I hope all of you know that. We have discussed that point in detail there. IT guys who are in collusion among employees. Did I discuss that in detail or not? What are the basic inherent limitations? So now the question that is being asked here in this clause is whether the accounting software that you are using, let it be anything, on or after 1/4/2022, when you are using any accounting software like that, whether the same has been operated throughout the year for all transactions recorded in the software, and there has been an audit trail feature which has not been tampered. So nobody can go back to the roots of the trial and change the trial itself with, and the audit trail has been preserved by the company as per statutory records for retention. You know the retention points, right? The retention points will apply for 8 years books of accounts, and for such books of accounts maintained through the accounting software, a full trial is required. Okay, so in short, if I have to sum up the points that we discussed in this particular clause, it goes on to the first one, talk about pending litigation, material foreseeable losses, delays in transfers to IEPF, and then channelizing money to ultimate beneficiaries, either from our side to ultimate beneficiary through an intermediary, or from a foreign entity through being an intermediary and channelizing it to other parties. And if there is anything suspicious in both clause 1 and 2, you have to report under point 4. And then point number 5 is declaration of dividend being in provisions of 123 cleanly and neatly, and all softwares that are used for accounting henceforth from 1/4/2022 should be capable of maintaining an audit trail which is a chronological record of all the transactions and should not be tampered with, and such audit trail has to be maintained for as many years as may be prescribed in the law. So all these are the points under 143 subsection 3 clause J, which is an extended part of the story, to the 143 subsection 3, where all the principal assertions have been reported. The Companies Amendment Act 2017, effective from 12th of September 2018, inserted a section 197 subsection 16, which says the auditor of the company shall in his report under 143 make a statement as to whether the remuneration paid by the company to its directors, is in accordance with the provisions of this section, and whether the remuneration paid to any director is in excess of the limit laid down. I hope you know that there is a 11% limit on 197. Whether anything has been paid in excess of that remuneration, such details also are supposed to be given. And little later, when we discuss audit reports, I will explain you in further detail. But for now, since it's given there, I'm telling that in audit report there are paragraphs with proper headings, title, addressee, and all that. So for reporting 143 subsection 1, this section 143 subsection 3, and a report in company auditors report order under 143 subsection 11, we will use one place which is titled as report on other legal and regulatory requirements, which I will anyway give you a complete detail of and show you in the sample audit report also when we are discussing in the audit report part. Okay, so that brings us to the end of section 143 subsection 3, quite an important and extensive section, guys.